Hello and welcome to the Defining Your Niche podcast, where we dive into alternative assets in commercial real estate, specifically self-storage and small bay industrial flex. I'm your host, Thaddeus Campbell. Really excited to host two guys today. They have the first place. These are the two guys I've been chasing the longest to get on the podcast before I got a yes. So really pleased to welcome Andy Bratt and Amit Tyagi, the principals at Gantry. They are debt brokers by trade, but just really good guys overall. So excited to kind of dig in and have a half an hour conversation. Guys, first and foremost, thanks so much for working your schedule so you could get on and spend a half hour with me.
Absolutely. Yeah, thanks for having us, Thaddeus. And I guess we played a little hard to get, which was a game that was played against me many years in the past. So it's finally nice to play it on my side this time.
The other side of the table probably feels pretty good, Andy.
That's right.
Too funny. Well, listen, we'll take it. And as I said, I've had so much respect for you. We met at a trade show a couple years ago and got a chance to sit down and just had and unfortunately haven't had a chance to work with you guys on a professional level yet, but we're working towards that. It's funny. Amit said something off camera about what we do for our favored clients. And I'm looking forward to getting to that place with you guys, but really excited to dig in, especially today. We're taping this on April 11th, a Friday, and what has been a rather tumultuous week in the world of finance and world economics for that matter. This will air the week after the ISS show. So, kind of timely in terms of what's going on in the self-storage world. I'm excited to dig in with you guys. I always start the podcast the same way. Andy, I apologize. I'm going to start with Amit. I'm going to save you for second with this question, only because you have more letters after your name, and we'll dig into that a little bit as we go through too. But I start the podcast the same way every time, which is self-storage is such a unique niche asset. Amit, I'll start with you. How did you find yourself getting into this asset class?
It was sort of circumstantial. I was an analyst at the company a long time ago, and we have a lot of insurance companies that we access here at Gantry that, along with the institutional world on the equity side, if we go back kind of Great Recession era and previous to that, the insurance companies on the lending side, the institutions on the equity side really weren't in the self-storage space yet. And we stumbled into the asset class because we saw the performance of the asset class coming out of the Great Recession. And a lot of our insurance companies were asking us about it. So we had these legacy clients at the firm who, were some of the original players in the self-storage world and met these families who go back some decades and had these lower leverage portfolios. So we started off with these sweetheart deals with the insurance companies and showed them 30% leverage right down the middle storage product. And so it has since then ballooned. We have done a variety of storage loans, definitely pushed the envelope over the years, well past the 30% leverage, and have some very unique structures going on now with in various forms. So long way of saying we were kind of nudged into the space by a lot of our good lenders, and now we have a pretty strong practice in the space.
Andy, I'll give you a chance to chime in on that question in case it has any variation from Amit's answer.
Yeah, no, it does, because I was at a different company prior. I joined Gantry in 2014. I did my first self-storage loan in 2011. I'm not sure how I met him, but I met Nick Walker while he was at Marks and Millichap, and he said, "Do you think you could help out one of my self-storage clients?" And I said, "Sure." I did a loan for that guy, and then kind of identified it as a kind of an alternative asset class. And once I joined Gantry in 2014, Amit and I kind of joined forces, 7 or 8 years ago or more maybe now, and really kind of made it a big focus and practice of ours. And so it's kind of evolved, kind of like Amit said, when we were first starting doing it, it was $3 to $5 million loans. And now they're, we did a $130 million portfolio a couple of years ago and a $70 million last year, and many other sizes as well. So the asset class has really grown. Also started investing in it with my clients, so probably 2017. So have been on that side of it. And Amit and I have a mutual client that we've both invested with as well. So we finance it. We love the space, and we're also invested in it. So
So this opens up the next logical question for me because kind of both of you, listen, you've been in this for an interesting run of say 15 years where you've kind of seen a lot of different variations of what self storage looks like, going all the way back to 2011, where you're 30% leverage is like a dream for a lender, right? That's what everyone's looking for. Whereas now today we're in a little bit different dynamic with what the needs are financially, and kind of talk me through how the industry has evolved in your time in it. I'll
Andy?
go.
well, yeah, I think I'll just start. I mean, just the sophistication of all like sectors of the industry. When we first went to an ISS conference in Vegas, going back probably 2016 or so, 2017 maybe, um, it was the one of the first people we saw was a guy, very large man wearing overalls, and just it was so it just the industry has evolved so much where it's become highly sophisticated. There's institutional capital, and it's become a household kind of asset class. Not I wouldn't even call it an alternative anymore. It's the four major food groups and storage and hospitality. It's everybody wants to be in it. Institutions down to the first time developer. So we've seen it grow pretty significantly, especially from the capital side. Maybe I'll let Amit talk about how our lenders have evolved in the space as well.
Yeah,
I'm going to let Amit say that. I just wanted to laugh because I got to redo my intro because I always say alternative assets in commercial real estate. Self storage really kind of has I talk about this with people. It's not really an adolescent or an infant asset class in any way, shape, or form. Anyway, I want to chime in, but Amit, take it away.
Yeah, I mean that's a good point. That is, if we go back to again pre Great Recession, the lenders in the space were primarily banks and CMBS, and so the evolution of the lending world really started with the insurance companies, and in the last 15 years or so, we've seen the advent of debt funds and others who have now warmed up to the space. And I'd say generally, there is widespread market activity in every lending avenue for self storage. And so it really has become a favored asset class. The word alternative is funny for storage nowadays. I mean, it was at some point an alternative asset class. And if we look at what are sweetheart asset classes for lenders, you start with multifamily and industrial. It's the two that are sort of the bread and butter. And if you look at what's next in line, maybe it's grocery anchored retail, but I'd put self storage right up against grocery anchored retail these days. There are hesitancy for certain characteristics in retail that lenders will have, and self storage has grown to really now be a preferred asset class for a lot of lenders, and so it's less alternative than it used to be.
It sounds catchy in the intro to the podcast. I'm gonna have to work on it to get something that
No,
sounds that
I think
catchy again.
it's. I don't think you need to change anything. It's just I think it's evolved from that. So the
Yeah,
evolvement of alternative
yeah,
asset
that's
class, right?
great.
Yeah.
That's too cool. So I wanted to kind of ask you, because this is something that I listen, I'm new. I got in storage in August of 2021. I'm still learning daily, and not that we all aren't, but I'm very new in this industry. And when I first met you guys, it was the first time I ever really kind of heard. I didn't even know insurance companies lent money. Like that's how new I was in this world. I was a martial arts teacher. That was my background. I punched people in the head for a living and got punched. So talk to me about insurance lending and how it differs from traditional bank lending, and where maybe are the advantages and disadvantages for somebody who's doing a 70 million, 130 million, or $7 million project.
Yeah, I think there are tremendous benefits. I guess to start, insurance companies are commercial real estate lenders. That is, they actually make up an enormous part of the marketplace. I would be speculating to guess exactly what that size is, but it's in the many hundreds of billions that insurance companies will annually lend in commercial real estate, and it's grown with within the storage space as well. Insurance companies, these are primarily life insurance companies that we're talking
Yeah.
about. And so their capital really comes from individuals who are making life insurance premium payments over their lives. And so what insurance companies are managing to is assets that they produce on their books, like mortgages, matching liabilities for future events. And so
Yeah.
they have a unique ability in the lending world to provide uh, balance sheet loans that they can take a longer term view of these assets and business
Yeah.
plans better than other lending avenues can. They are so we saw the banks get exposed from an asset liability matching perspective in the last 3 years. We
Yeah.
saw that there were banks who had, whether it was treasuries or long dated fixed income assets, that they had to write down during the run up in interest rates, and it hurt a lot of their balance sheets. And much of that bank world is still either sidelined or slowly recovering at this point. There's not a mass move back to the playing field from that sector. And it really was asset liability matching and accounting mechanisms, mark to market on those fixed income assets hurt bank balance sheets in a big way
Yeah.
quarter after quarter for a couple of years. And
Yeah.
the insurance companies are very different in that by the nature of their capital and the asset liability matching that they have to manage, they have the ability to hold a lot of their fixed income assets to maturity, meaning they're not subject to market. So their balance sheets have remained resilient. And then if we think about the life insurance companies' flow of funds versus the banks, any one of us could go to our bank tomorrow and pull all our dollars out of there. The banks have to be able to respond to their depositors at any moment, and we saw some of that when the banks were starting to fail. There were lines around the block at First Republic Bank branches all over Los Angeles, and
Yeah.
there was a run on the banks. And with insurance companies, most people, even during recessionary times, continue to make their life insurance premiums. It seems to be a baseline fundamental for so many people's investment and wealth plans that there's never a moment in time where they really forego making those payments. And so the life insurance companies, good times, bad times, and otherwise, continue to have to match assets against liabilities and produce fixed income assets and produce commercial mortgages. So we see a stability in that avenue that is not necessarily there in others. We saw relationship banks who all of a sudden weren't able to step up for their relationships. And the folks
Yeah.
who had relationships with the insurance companies had this stable avenue of lenders. We're all subject to higher rates and this and that, but at least they had people who were open for business. So I threw a lot out there. Maybe I'll pause
No,
for a minute.
I love it. And listen, to your point, like higher rates is higher rates, but at the end of the day, when you have a project as a developer, right? When we've got a project and we've got permits and all of a sudden our relationship bank won't lend on us, 1-2%, hopefully, if the deal is underwritten correctly, is not going to kill you. It's getting it out of the not getting it out of the ground is what kills you, right? Like if you don't get the thing built, that's where you die on the vine. So that ability to have somebody who can get it done is many times more important than what the rate is. Not that we love when rates double, that doesn't help us as developers, but on the flip side, the real danger is not getting the thing built when you're already, hundreds of thousands, if you bought the land already, millions of dollars into the project.
100%. And it doesn't help. Higher rates don't help us on our side of the business either, too. It was way
No.
easier selling 3% paper than it is 8% paper. So we we feel the effects of it too. But in a market
I
where,
noticed how you said the 130 million refi a few years ago, and it wasn't last year or this year, right?
hey, we did a $70 million loan that closed in December, and we've had a lot of activity over the years. So like you said, we're fortunate to have these reliable lenders, and the execution is what we need to be able to manage in our business. Our ability to get our sponsors across the finish line on these transactions is what makes or breaks us in our careers. Our reputations rely on it.
Yeah.
And as developers, you can't keep going to banks and avenues where there will be failures along the way and an inability to execute. It's harmful, and it's time that we don't have, and there's going to be costs and fees and things along the way that are consuming. And so, yeah, we're fortunate to have the insurance companies there and open for business.
Tell me the downside. Where's the downside for a developer in going after life insurance money versus going after a bank?
Andy, I said all the good stuff. You want to take the bad
Yeah,
stuff?
thanks. Yeah, that's nice. Good
That's
job,
a nice
man.
partner to have right there.
Yeah. Yeah, so I think historically thinking, the insurance companies, people view them as being a little bit more conservative or lower leverage. Um, that may or may not be the case with all insurance companies these days. So, while the banks might do stuff if you put deposits with them, they might give you a little bit more leverage, but they might be recourse. The insurance companies are going to typically be a non-recourse lender. I'd say kind of the one drawback is the prepayment penalty. So typically, if they're putting money out for 5, 7, or 10 years, it's more of a yield maintenance with some prepayment penalty flexibility at the end of the term. Now we correspond for 35 to 40 different insurance companies. That's semi-exclusive and exclusive capital that we represent. So we have every insurance company has a different program and can offer different things. So you can often get more prepayment flexibility, but I'd say by and large, it's typically the prepayment penalty is going to be a differentiator where it's going to be a little bit longer through the term of the loan. And so I think that's probably the biggest one, and maybe some of maybe a little lower leverage on proceeds when you compare it to a CMBS product or something like that.
If I'm a new developer and I'm going and I'm building, we've got a project we're working through. This is going to be a $6.5 million project. So, we're going to be maybe looking for $4 million of maybe $3.5 million of debt. Can I take that to a life insurance company and get funding on a project like that?
So I'd say that kind of goes into another area. I'd say insurance companies, while they're able to do construction financing, it's by and large kind of more focused on multifamily and industrial. We do have insurance companies that will lend on construction for self
That
storage assets,
I
but
didn't
it's
mention that's an industrial project, not it's a small bay
oh, there
industrial
you go.
flex.
So
So,
small bay
I,
industrial, that's a different
yep,
story. But if so, yeah. So I guess it limits the pool of lenders in the insurance company world.
yeah,
On that, I think the insurance companies, are probably the best at stabilized assets and putting on, midterm to longer term debt.
yeah.
That's evolved over the last 15 years since the GFC, when they were putting money out. We were doing loans at 2.25 to 2 3/4 with the insurance companies fixed for 10 years. So during that time, we had they wanted to look. They created other buckets of capital to get yield. Some of those were bridge capital, so value add and construction, some more opportunistic buckets. So those do exist. Lenders also, we have the low spread lenders on the life insurance company side, all the way up to kind of maybe pushing proceeds or core plus buckets of money. So there's a lot of different programs out there that they can kind of barbell and get the best pricing on one side on a very stabilized asset, and for something either construction or more transitional can maybe get a little bit more yield, but those are still priced better than most of the other lenders out there. The size, I think 10 plus million is a good size, 10 to
Yeah.
15 for construction and up. When you start to dip below, 10, the construction is a little bit more challenging. But on like other assets like stabilizer bridge, yeah, they start in the $3 to $5 million range and up.
That was kind of where I was. I was trying to be subtle with my question. Sorry, Amit. I'll wrap this up quick. But one of the issues with life insurance versus a smaller local bank is that they don't want to write a small check.
There are some that, so we, out of our 35 to 40 like correspondent life insurance companies, we stagger them. So we have the groups that'll do the $1 to $20 million loans, the 3 to 30, the 5 to 75, the 10 to 100, and 20 and to endless, right? But I think the if you start when it gets to construction, it's a little bit harder. So I think, yeah, that's more of your local bank for an asset of like sub $5 million, which we do plenty of that, right? We'll do loans with 150 lenders each year, and that's banks, CMBS, debt funds, agencies, but a big bulk of our business is done with the insurance companies. Where last year, partly due to the fact that the banks were out of the market the last few years,
Yeah.
the insurance company market has grown and they've taken more market share. So I think it was something like 37% increase in insurance company um, loan origination is what the recent number I saw. So for us, we used to kind of play 55 to 65% of our debt origination each year was with the life cos. Last year was closer to 75%. And that's just because the life insurance companies really are the reliable, stable, consistent capital source. Even going back to the GFC, capital was frozen, right? Now there's at least plenty of capital out there. People just don't like the rates or the cost.
Yeah.
In
Or the
2007,
terms.
or the
Yeah.
terms, right? Yeah,
Yeah.
but it's available. Going back to 2007, 8, 9, 10,
Yeah.
capital was frozen. Well,
Frozen.
the one place you could still get conservative loans done was with the insurance companies. They still have their allocations. As Amit mentioned earlier, you didn't stop paying your life insurance policy, right? So as they bring in these hundreds of billions of dollars or trillions of dollars of premium each year, they need to go invest that to pay for future claims.
Right.
And I'm going to tie it back to your word alternative here. Uh, Commercial mortgages are an alternative asset investment class for the insurance companies. They'll buy stocks, bonds, equities, etc. But the commercial mortgage, loans have been a very, good, consistent origination for them as an alternative investment.
It leads me to a great question that I wanted to bring up today because we've seen kind of a crazy. It's been a crazy week in the bond market, right? Treasuries went from under 4 to 4.5 almost. I mean, it was a crazy basis change. How does that affect you guys as far as access to capital and getting debt for people when all of a sudden such a safe investment becomes, you get half of a point basis in a week rise? Does that have any effect on you guys at all?
I'll let our bond guy take this one.
Is he on the line?
Yeah, right.
Well
Yeah,
played, Amit.
Uh,
Well
we
played.
call in a friend.
um, well, so Thaddeus, I think the way I'll start with the response here is the direction of the move almost doesn't matter as much as the size of it. The volatility in any direction is going to cause ripples through our world. It's a reality. So in the last week, there are a number of lenders who have had to pause and see where things are settling. And different lenders will take different approaches on this now. So we have in any given avenue. So there are probably some insurance companies that are still on the sideline waiting for the dust to settle and will be a little bit more reactionary based on what their peers are going to do. But then there are others who have started moving things around. So in this type of moment of volatility, with what we're seeing today, spreads have moved and the indices have moved. We saw that well, you brought up the Treasury. The Treasury as the index has jumped pretty dramatically. Historically, when times are a bit more stable, I think there's a normal reaction for spreads and treasuries to move inversely when things are kind of normal and the market's uh, somewhat stable. So when we see an increase in the indices, there can be a little bit of give on the spreads. We happen to be in a moment where both sides of the equation are getting hit and getting hit pretty hard. And so while the equities markets tend to see more headlines on the S&P 500 and the Dow and this and that, and the moves that are happening are very visible, the bond market might have actually taken a harder hit in this last week than the equities markets have. And so if you look at, for example, triple B corporate spreads, which is a particular index we tend to look at when we're pegging fixed income spreads, has jumped about 40% in the last week. And so there's a moment of pause that is going to almost every fixed income group is going to have to stop and look at. And so that's what a lot of these lenders have been doing now. But the good news is it's not widespread panic mode with the lenders. They're not all off the table. There are still deals that are getting done. We, as a company, there was a $50 million deal that locked right today, and that was with an insurance company. And so there's still activity in the marketplace, and we're not at a point yet where it has disrupted the it's a disruption, but it's not a dislocation, is what I'll say in the marketplace. And so the spread side of the equation, it's going to be different for different lending avenues right now. The insurance companies, we're hearing spreads have moved up anywhere from 10 to 25 basis points, maybe 30. The the bridge universe, we're hearing anything from 25 to 50 basis point spread movement. CMBS at one blip in time in the last week was up like 80 basis points of spread. So they're always a little bit more subject to volatility than other avenues are. And so I think there's macro level concerns that people are going to keep an eye on. And, I think the dollar weakening will impact bond market spreads further. So I think that's an element we're seeing now in the last week that I think people are going to start focusing on it. There were a few Fed governors who've made comments about the weakening dollar in the last few days as well. So it's things are changing, but that's some of what the change that we've seen. But there's a still path to getting deals moving these days.
I'm going to just remind people that are listening that this is being taped on April 11th, which has been the dramatic week of tariffs and international discourse. So this will air on April 30th. So there's going to be a little bit, we got 19 more days to see how things settle before this actually comes out. But we're trying to prognosticate a little bit. Super appreciate your insight. And it's so educational for me. It's one of the reasons, quite frankly, I love doing the podcast is because I learn so much from people like you. What I wanted to ask, and this is open to either of you, how much does 2023, 2024, 2025 really kind of show who the players are in the space, right? In 2020, 2021, I think I could have gotten a job selling debt and probably done some business. Now and you mentioned it, and by the way, I'm going to say that when I made the comment about 130 million, and it was a few years ago, no way meant to disparage you guys, just the reality of the willingness of people to want, of course they want to refinance their debt when interest rates are 2.5-3%. Who wouldn't want to refinance there? And I guess we haven't gone far enough yet from those times where people are actively coming up on their we're getting there, right? 5-year balloon payments are starting to come up on those. But my question again, how much does 2024, 2023 coming into 2025 really shown who are the people in this space who really know what they're doing?
I think it's dramatic. I think it's dramatic for people in our business. I think it's dramatic for self-storage owners and operators. I think it's very visible who the real players are and not. I guess from our business, if we were to rewind the clock and go back to the 2.25 to 275 interest rate environment that we were in before, debt was somewhat of a commodity. Let's be frank about it. I mean, if you were to whiff on a mortgage and not take the best deal that was out there, maybe you missed by 10 or 20 basis points. It wasn't a big deal.
Right.
In today's world, if you whiff on a mortgage, that could be a full point on that whiff. And so things have really stretched and really, really moved dramatically. So when we were in that 2.25 interest rate environment, if permanent loans were getting done at 2.25, bridge loans were getting done at 3%, and construction loans maybe 3.5%, give or take, plus or minus. In today's world, if perm loans are getting done at 5.5%, bridge loans are at 7.5%, and construction loans are closer to 9%, there's a lot of gapping out across the rate spectrum that if you're not, I think the folks who are just taking in our business deals to their friends or not really understanding the market, not having the scale and the depth and the reach of the greater lending universe, have probably seen their business fall off in a big, big way. And so I think there's a lot of reasons why being resilient through that market, understanding who the players are, the activity, all of that has kept us alive and at the forefront and doing business. And so I think a lot of people were exposed. And then on the storage side, I think it's the same thing. I think for a lot of our developers, the industry saw a humongous influx of supply coming in from every different angle. There was the established, experienced storage developers who were developing, it's their business. And then there were a lot of people who were trying to get their first deals done in markets where it was easy to build. And they were able to make some money when the construction debt was 310 or 320. It was hard to whiff. And then
literally could throw a dartboard at the map of the US and find a spot that penciled to develop to a 3.5x to a
right.
4.5x. This is where I came in August of 2021 with a new developer, and that's what was happening. You were throwing a dart at a dart. And listen, I say dart at a dartboard. There were demographics you were looking for, but because of the way rates were, and because of the way, and on both sides, right? Storage rental rates and then rates on interest rates, it was hard not to make a deal pencil.
100%. Yeah.
Yeah, I think in last year, someone recently told me, I don't have this verified yet, but someone said more first time developers broke ground last year than ever before.
That
And
was
so, go
just
ahead.
to tell you, Armand Nagajanians, who's super active on LinkedIn and really data driven guy. I saw something he posted that said that he cited sources. So just to verify what you're saying, somebody who I trust implicitly and actually cited the source in his comment. Same thing, right? And not just more new developers than ever, but more first time developers than repeat developers building
That's
self
right.
storage, which is crazy.
So I think what you've seen is, you have the first time developers that have over the last handful of years saw everybody making all this money in self storage, and people were jumping in from their day job. We have some neurosurgeons and doctors that started developing self storage, and there's nothing wrong with that. But I think it's just so many all at once
Yeah.
started jumping into the industry, and that's obviously led to. Obviously the housing market movement hasn't helped, and that's caused some softness. But it's the supply is where a lot of these new entrants came in, and a lot of these groups were syndicating and going high leverage, right? So if you were taking out a high leverage bridge or construction loan 3 to 5 years ago, to Amit's point, I mean, the interest rate is double, if not more, right? Double
Yeah.
or triple in some
Yeah.
instances from what you underwrote. So there's been a big change, obviously, and we've seen an interesting dynamic between our kind of long experienced clients and developers that are either developing or acquiring, where some of them have gotten really conservative in their underwriting and kind of taking the pause, and some are being just a lot more selective on the sites that they develop in and making sure all the it's an infill market or there's good supply demand characteristics and great demographics, everything that we should have always been doing. But COVID pulled so much of that self
Yeah.
storage demand forward, and
And listen,
everybody, yeah,
yeah, I was gonna say, like, for someone who was getting started in 2020 or 2021, you don't know any different. So how do you underwrite to a normal period when you didn't live through that normal period, right? Which goes back to the initial question, which is, 2023, 2024, they kind of show who the players are, and for unfortunately, this is a reality of capitalism and the world we live in. People get burned, and sadly, in this state, it can be, in this asset, it can be millions upon millions of dollars that people see go away. Again, why I have you guys on, and why I hope people listen and get to know you guys is because it's times like these where you really need to have the right people in your ear.
that's right. And I think we provide with the insurance capital just all different alternatives for capital sources and just a much bigger, call it lender playbook. And because we service $23 billion of loans, and that's probably 90-ish%, 95 comprised of the insurance companies. So we know the capital, we know we're that close to it, we service for it, we know how to create different buckets of money. Amit and I were very pioneering. 7, 8 years ago, we had a client in need of paying off his construction loans very early on in lease up. And so we created a structured perm product with our insurance companies that would give fixed rate debt as if it were a perm loan on something that really had a transitional or bridge loan type of profile. So that has been a huge tool. And outside the insurance companies, banks could maybe do some of that, but not in the way that we were doing it. And those are some of the big portfolios that we have done and executed on. And so that, I think, separates us from some of our peers having that insurance company money
Oh, yeah.
capital.
Yeah, the way I would explain that to Andy is the kind of the perm versus bridge versus construction kind of breakdown that I used before. We have this unique ability with the insurance companies, and also credit to a lot of the work that we collectively have done ourselves to get there. Is we understand exactly how the money works. We service 23 billion. We understand the mechanics of what we can and can't do. Andy and I have read the NAIC guidelines back and forth how many times to each other to try to understand the dynamics of what we can do extremely well. And so being able to pull all that together, what we've been able to do is if something sort of fits in between a perm and bridge profile type of a loan, we have tools at our fingertips that are available that someone who isn't as studied or as familiar with the capital will not be able to pull off. And
Right.
so it's proven to be very advantageous for us, and it's a unique set of uh, language and documents and things that we have to pull together to come up with some of these structures that we are able to do that our peers might not be as comfortable or able to do.
Guys, as hard as it's to believe, it's been 35 minutes since we started this conversation. I try very hard to keep to 30 minutes, both for your, to honor your time, but also for the viewers to make sure that it's something they can listen to in one setting. I didn't even get to the CCIM letters after Andy's name. I was planning on asking about that, but we can come back another time. Hopefully it doesn't take me a year of asking you guys to come on the podcast the next time to get you to come back on. Can't thank you enough. The information is incredible. We've got your information. We'll be scrolling across the bottom. But I'll ask you guys, if somebody wants to get a hold of you, wants to talk about different products and different loans or different projects they might have going on, what's the best way to get a hold of you?
Email, phone call, track us down. We're here. We live and breathe this stuff, so we're happy to. As you can tell, 35 minutes went by quick. We can talk about this stuff endlessly. So always happy to have a conversation and talk through these dynamics with people.
I will have your phone numbers and your email addresses scrolling across. If you guys have any trouble getting a hold of these guys, reach out to me and I'll get in contact with them quick as well. Just really grateful for you to come on and share so much knowledge. And the one thing I would say about you is just the enthusiasm for what you do is obvious, right? As you said, I literally prepared one question for this meeting and I knew it was going to be that easy to talk to you guys because you guys are just infectious that way. You have enthusiasm for what it is you're doing. So it's pretty easy to keep the conversation flowing. I appreciate you guys sharing that time with me.
Thaddeus, this was a blast. Yeah, thank you for having us,
Yeah.
and we're ready for the next one.
I love
No,
it, love it, love it. Hey,
thanks so
listen,
much,
that's it
Thaddeus.
for
It was
this week's
great.
episode of the Defining Your Niche podcast. I got to come up with a different name than Exploring Alternative Asset Classes because we decided self-storage is no longer alternative. Listen, if you got anything of value here, give us a like, subscribe to the channel, give us a comment. We are all across YouTube, Apple, Spotify. You can find us at a bunch of different places. We appreciate you guys listening, and we'll see you next week.